Let's bring in Joe Livornia, the chief economist of the Americas at Natixis. Joe, great to see you again.
Thank you. Great to be with you guys.
Have we seen the best of it in terms of growth, and how much of a slowdown should we brace ourselves for?
We have seen the peak in growth. I was calling for that several months ago, and partly it reflects, Melissa, that this year will be a boom for growth. We'll see GDP up near 7%. And historically, if we grow at 6 or more, which we will for 2021, the economy in the following year on average falls by half of that, or grows at half as fast. So if we're at 7, historically, we'd be at 3.5. We were at 6, we grow at 3. However, given the amount of stimulus the government has put in the economy, and the focus all being on the consumer and the pent-up demand, as Tim was saying earlier, we've pulled a significant amount of stimulus forward. So next year, growth will disappoint consensus. And I look for real GDP measured on a Q4 basis of sub 2%, which will make it very hard for the Fed to taper and, of course, very hard for the Fed to tighten.
Joe, so let me ask you, I'm not quite sure the last thing you said, but my question is about inflation. And what if inflation is lower, does that help GDP, or is inflation higher better for GDP?
Well, I'm looking at real GDP, Karen. So, I mean, if we're getting inflation, that's a problem, and it reflects the fact the economy is operating above its long-term potential. OMB sees potential GDP at sub 2%. So that's where we'll be next year. But the inflation I don't think we have a lot of inflation coming, but where we're going to have inflation, which we haven't really seen yet, is on the housing side, specifically rents, which lag this massive run-up we've seen in home prices. So you're going to get some moderation in goods because Tim is buying a lot of toasters, but the toaster demand will weaken.
Absolutely.
But on the rental side, which is the dominant driver of inflation, you're going to see higher prices. So we're going to be in a situation next year where growth is going to slow pretty sharply. Inflation, it's not going to be like the 70s, but you're going to see higher inflation than what we've been accustomed to. So it'll be a little bit stagflationary in some sense.
Do you think that inflation lasting through next year or until next year, is that transitory, Joe? I'm just trying to,
No, it's not.
What does an economist think of transitory in the Fed's use of the term?
So, Melissa, what I had believed for much of the spring that this would be transitory because it was a post-pandemic reopening and there was a lot of demand and supply couldn't catch up. There were COVID restrictions, et cetera. And eventually these price pressures would moderate. I still think that to be the case. But given the amount of government spending we've had since then, we passed a $1.9 trillion package in March. We're likely to pass an infrastructure bill. We may pass an American Families Plan, which is another $3+ trillion. I mean, we're spending so much money. We're running deficits that are so high. In fact, if you look at the OMB's forecasts versus the CBO's, OMB is forecasting cumulative deficit to GDP 13 points higher than CBO for the next 5 years. And if that's the environment we're in, that transitory inflation will become permanent. I'm sorry, there's just no way around it.
So, but Joe, this brings us back to the Fed, which is where you're going with this. They're trying to monetize a deficit. They can't really raise rates. But I'm worried about, as a market participant, I'm not asking you to make a call there. But what does this mean for the Fed and what you think they're seeing that we're going to hear tomorrow about this inflation that's out there? Because I think the market, we talked about this. There's no way you can dismiss the Fed begin to taper, even if their balance sheet continues to grow, in my view.
Tim, here's the problem for the Fed. The Fed is in a box. Treasury supply has been very low this year relative to the size of the deficit because the Treasury has run down its cash balance by over $1 trillion. The Treasury has to issue a lot more debt. If they do the spending that they might get through, they get to issue even more debt. I don't see how the Fed, which has bought roughly 46% of net marketable issuance since this pandemic began, I don't see how the Fed can ever back away, can ever taper. They're the big buyer. So really, monetary policy at this point is going to be hostage to what happens on the fiscal side. What does Congress do when it comes back next month? That really is going to dictate, to my mind, where interest rates go and by default equities, because we know the Fed has used QE in the asset channel, specifically stocks, as the primary conduit of monetary policy.
Joe, great to get your thoughts. Good to see you.
Thanks, everybody.
Joe Livornia of Natixis. Mike Coe, what do you make of all this? The Fed in a box. Is that so terrible?
Yeah, I think it's a pretty sticky situation, of course. Although, I mean, we've seen in other economies that you can be in that sticky situation for a relatively long time, but that doesn't necessarily mean that you have good real economic growth for a period. I mean, so we had a situation. We can look at places like Japan where they've had massive debt issuance. They've obviously been able to, keep their rates relatively low, but going along with that is that they've had a relatively slow growing economy. Now, in our case, what we worry about, of course, is that we have the relatively slow growing economy, but then we combine that instead of with basically no inflation or even a deflationary environment, kind of like they experienced there, with an inflationary environment. And if we get that, that's going to be quite unhealthy. And I will say that, as much power as the Fed has, it could actually get a bit out of control. And I think that's how those things tend to happen.
Guy, your thoughts?
Joe, speaking my language, I agree. I mean, he does not believe this inflation pressures are going to be transitory. I agree with him there. And, if you see sort of the stagflation environment, I've read some textbooks, but I don't think there's any arrow in the Fed's quiver that can combat that. So it creates a bit of a problem for them. The one thing that I would continue to watch, and probably Tim can speak to this as well, the relative strength of the dollar has been interesting lately. You wonder what happens to the dollar under the backdrop that Joe just talked about. That's something I would be watching as well.